Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Drew T. Mattis with us earlier this morning was citing the thoughts of Neil Dutta. He joins us from Renmac right now. Neil, I'm sorry, all the blah, blah, blah is 3.2% was survey, and CPI CPI year over year was 3%, and it comes in at 2.9%. I believe that's below 3%.
Yeah, it is, Tom. I mean, thanks for having me on. I mean, core CPI inflation rose just 1.6% at an annual rate over the last 3 months. I mean, that suggests that we're sort of on track. I do think if you peel back the onion a little bit, there is some interesting kind of details, which sort of leads me to believe that perhaps the core PCE number may not be as soft as what we saw with CPI. As an example, medical care services inflation in CPI declined 30 basis points over the month. I don't think the PCE equivalent is going to be nearly that weak. And we did see an unexpected perking up of rental inflation over the month. So rent of primary residence, after collapsing in June, kind of gave some of that back in July. But, we have to kind of go through the numbers. But, look, I mean, to me, it's really about balance of risks at this point. The unemployment rate has been climbing, and core inflation has been slowing. And we know that inflation is a lagging indicator. So whatever inflation is at the moment, that represents yesterday's monetary policy. So if inflation has already been slowing, I think, just based on inertia, there's probably more room for it to keep moderating. And so I think the Fed needs to kind of get going here. The markets right now seem to be looking at September as sort of a coin flip between 50 and 25. Right. And, in my mind, I mean, I think the slowing in the economy and the fact that the inflation situation has broadly been kind of resolved, in my view, I think that that will allow the Fed to go, I think, a bit more aggressively than not.
Justin Wolfers at Michigan out with the headline here, Paul. Importantly, nearly all the rise in CPI, as Mr. Dutta mentions, was due to shelter, which is a backward-looking measure. Wolfers of Michigan.
Interesting. So, Neil, how about for the hawks on the Fed? What is the PPI and CPI data? What do you think how they're interpreting it?
I mean, lately it seems like the hawks will just find whatever excuse to kind of justify a tighter policy. I mean, I think what's interesting is, in recent days, just how anchored the hawks have been to the June summary of economic projections. If you recall, that projection had just one cut baked into the year for the year. And I think what's interesting about that is, I mean, Powell basically said that they were talking about cuts as soon as July, and he kind of teed up September. So what's been surprising is just how out of sync the hawks of late look relative to what Powell was saying in July. So, I don't know. I don't really what to make of that. I mean, I do think that the Fed speak is a little bit out of sync here, quite frankly. We'll see what Powell says at I think there's obviously a lot riding on that. But I do think that it's also a sort of admission by omission by just how kind of skittish the doves have been. They have a lot to press their case, guys. I mean, the unemployment rate's been rising, quits have been declining, which means that wages are slowing. So where's the inflation really coming from? So I've been surprised not only from how hawkish the hawks have been, but how little the doves have been speaking.
The VIX under 18, 17.96 moments ago. Mohammed El Arian, thank you for joining us the other day. Dr. El Arian noticing the surprise cut by the Reserve Bank of New Zealand. Neil, do you sense worldwide a new churning of respected and less respected central banks cutting rates? Is that the trend here?
I mean, you've generally seen foreign central banks cut sooner than the Fed. I mean, that's the ECB. There was a weaker than expected, I think, inflation report out of the UK earlier. That's kind of fueling bets that rate cuts are going to happen a bit sooner than previously anticipated. Obviously, and the Bank of Canada has been already easing, and inflation over there has generally been slowing. So it's the Fed that looks out of sync with the rest of the world. And frankly, the trade-offs are not all that different. As I mentioned, as I think the Fed has kind of like a little bit behind here. And that's primarily because of the risks around the unemployment situation. Unemployment has been climbing here in the US. And one of the reasons why it's climbing is because it's more challenging for the recently laid off to find jobs. So that's kind of, increasing the stock of unemployment because it's taking longer for people to cycle out of unemployment and find a job. And I suspect that continues because nothing about the near-term growth outlook suggests that the unemployment situation is going to stabilize on its own. Growth is moderating as we see slower residential investment, we see weaker consumer spending, and that's going to ultimately take some of the juice out of the employment market.
And Paul, do you think I'm wrong here that I'm saying, okay, I'm sorry, 2.9 is not 3.0?
Right.
It's like, $19.99 for a case of Cheez-Its.
Right.
It's not $20.
It's not $20.
I'm sorry. And it's same with the unemployment. When do we get to 4.9?
I don't know.
And we hit 5?
Yeah. Exactly.
It's different than 4.9.
It is. Hey, Neil, where is this U.S. economy here? Has the Fed, perhaps waiting too long to cut rates, is it really brought a recession risk maybe a little bit more on the front burner?
Well, I don't know that it depends how, so I'll put it to you this way. I think that the markets are a little bit underestimating recession risk. Does that mean that I think we're going to have a recession? No. But the way I think about it, this may sound a little bit too cute, but the recession risk rises the longer the Fed waits. And then once the Fed gets going, I think the recession risk will start to fall quite rapidly. That's sort of how I'm thinking about it. But I do think that the risk right now is that the Fed underdelivers and that the economy is still slowing. And so I think that's generally more of a negative setup for risk appetite.
And I guess we're going to get a better sense of the consumer tomorrow, retail sales. We're also going to get some Walmart earnings as well. And boy, that's such a barometer of how the U.S. consumer is doing. How is the U.S. consumer doing from your perspective?
I think the consumer is kind of meh, I don't think it's obviously, I don't think it's gangbusters. It's not falling off a cliff either, but there's nothing particularly exciting about consumer spending right now. We're probably growing something in the vicinity of 2% in real terms at most. I do think when you look at it, consumers to me are increasingly resistant to higher prices. That's one implication of the fact that household inflation expectations have been coming down.
Right.
By extension, that means that people are resisting higher prices and they're making more trade-offs with respect to value and volume. And that's not how you get a demand-driven inflation if people are making those trade-offs.
Neil, can I ask the dumb question of the day? Thank you, folks. I'll do that across the nation. So when the Fed cuts rates, what exactly happens to our economy? What will you look for?
Well, the first thing I'd expect to see is certain private sector borrowing rates kind of adjust once the Fed begins easing. But I'd keep an eye on credit sensitive areas of the economy. That's what you'd expect to light up. One of the reasons why I was leaning against recession in 2023 was because incomes were rising rapidly, right? Because the labor markets were fine and inflation was slowing, so real incomes were surging. That's no longer the case. So you need to create a handoff from incomes to more credit-sensitive areas of the economy. So that's what I'm going to be looking for. Things that are tied to more income-based consumption, those will be slowing given what we're seeing in the labor markets. But credit-sensitive areas need to pick up the slack, and that requires a bit of Fed easing. So that's why I think, the thing to look at really is just what's going on with the housing market. So far, what we're seeing is refinancings have picked up, but you haven't really seen much of a positive impulse in mortgage purchase demand. You need to see that, I think, if you're going to talk about growth, stabilizing in a meaningful way.
One final question. Do you sense that is a marginal incremental change in the 30-year mortgage rate, or is it like a jump condition where all of a sudden, boom, we get a new housing market?
Well, I mean, I certainly think that mortgage rates need to fall a lot more from here in order to juice the housing market, which means that the Fed has a little bit of work to do. It's interesting. If you look at mortgage rates, I mean, they're basically running at the lowest level since, I think, last spring. But you haven't really seen home sales or purchase demand run at the best level since last spring. So why would that be? And that's because I think inflation has slowed more rapidly. So 6.5% on a 30-year fixed looks a lot better when inflation's 4.5% than when it's 2%. And so just a reminder that real rates are still quite elevated.
Neil Dutta, thank you so much. Greatly appreciate it on this day of inflation. Who's got the best job on Wall Street, Paul?
Steve Ricchiuto?
Alex Pell. Is that how you pronounce it? Alex Pell? Alex Pell gets to work with Stephen Ricchiuto and Dominique Constant.
Oh, okay.
I mean, this is like nirvana. Alex, if you're listening, you got the best job on Wall Street. When you get angry, what do you lecture young Alex on?
Well, number one, in this day and age, you can't get angry. But typically, the reality is younger economists don't really understand Keynesian economics.
Right.
Because they've stopped teaching it. And
100% agree.
The basic ISLM analysis that we all learned and had to get drilled into our head is something they all just ignore. And that's an important understanding component in terms of figuring things out easily and quickly on the fly.
Where is the dynamics is always LM, Fed. What are the dynamics of the IS curve right now?
Well, I think the IS curve is going to run a risk of shifting to the right. And that just implies that the underlying intersection between growth and interest rates could wind up being higher. And that, I think, is the risk that we're going to run that a lot of people don't really take into consideration as they, push for the Federal Reserve to cut interest rates.
So if you filter that through DSGE of Gertler and Clarida, Richard Clarida, very generous with his time with us last month, and he made clear, away from the academic mumbo-jumbo of your Columbia, Richard Clarida made clear he sees a reset above 2.0%. If the IS curve shifts, that's one way you get there, right?
That's 100% correct.
I did okay there?
Yep,
Lisa,
did.
Can you get me an extra bag of Cheez-Its? I deserve it today.
You got it.
Okay. So, Steve, has the Fed waited too long that for people like me, I should start worrying about a recession?
No, they haven't waited too long whatsoever. I think the real risk in here is that they move more quickly than they fundamentally should, and you wind up with a reacceleration of inflation. And that, I think, is the bigger risk. Because to me, in the environment where the IS curve, as we were talking a minute ago, shifts to the right, it's shifting to the right in an environment where we are not dealing with the new normal period. And we're dealing with a real normal. The new normal was the anomaly.
Okay.
The real normal environment that we're looking at is much further to the right. And now if we're looking at a risk of shifting further to the right, it's higher interest rates and higher growth because you have higher inflation.
Do we have a solid labor market here at 4.3%?
4.3%. You have a very solid labor market. And that's the point. I mean, the traditional measure of the natural rate of unemployment is 4.5. And where we keep on adjusting these numbers at the Fed's level, we keep on lowering the bar in order to cut interest rates. First, they lowered the bar by raising the inflation number that was consistent with them cutting rates. Then they lowered the bar again by lowering the unemployment rate that was consistent with them cutting rates. And now at the last meeting, basically the chairman says, well, if things just stay where they are, we can cut rates.
In Newtonian plug-and-chug mathematics, we have a Taylor rule. You got a couple plugins there, and one of them is the labor dynamic of America. Out of Jackson Hole, is there any efficacy to the Taylor rule when Royal Bank of New Zealand cuts interest rates today? I mean, is the Taylor rule in play at Jackson Hole to say, let's go?
Well, I mean, I think there is this desire to cut rates, which is what you're getting at. And I think you're seeing that in a number of places. You have to look at a number of places have a different macroeconomic environment than we do. That's number one. Number two, I think when you're looking at what's happening, watch the currency. The currency is critical here because it's a debate, or it's a battle in the U.S. between domestic cyclical forces and global deflationary forces. And those global deflationary forces are real. They're palpable. I understand them. You don't have to go much beyond than just looking at the latest news coming out of China, and have to look at what's happening in terms of Europe and other parts around the world. Global deflation is real, but so is domestic cyclical inflation. And the currency has been the factor. DXY, your Bloomberg measure on the currency, went from parity 100 to 116. We're now coming back. We're at 102. I don't know what it is right now, but we broke through the 103 level. We're heading towards 102 earlier today. You get back to parity, and guess what? The dollar's no longer allowing global disinflation to be imported into the U.S. economy.
So is the U.S. economy relative to the rest of the world still, I use the term, exceptional?
Yeah, I mean, it really is. We have the liquidity involved. We have strong balance sheets. We had a very activist fiscal policy approach. We still have an activist fiscal policy approach. We have a very broad, deep financial market that's looking at conditions, and corporations are looking at this environment and saying, This is a great environment to come in and borrow money and deal with my financing because these levels of rates are going to be low a year from now.
One of my it's not like I've been overt about it, but I think everybody that listens knows I believe we're going to have a debt issuance frenzy here as CFOs continue, particularly off a $20 billion Mars transaction. Very quickly, Steve Ricchiuto, to Jackson Hole, what does Powell have to say, or what does Powell have to not say?
Well, he's going to repeat everything he said in the post-meeting press conference. This is a chairman who lines up on the side of wanting to cut rates, but he wants a unanimous decision, and he's getting pushback on that unanimous decision. So I think at Jackson Hole, he bides his time. He just does what he did at the post-meeting press conference, which was go beyond the policy statement. Very succinctly, he went well beyond the policy statement. He's gotten some pushback. So I think we see a chairman that goes no further than he did at the post-meeting press conference.
Steve Ricchiuto, thank you so much. With Mizuho this week. Joining us now, really to get us started, in just a perfect moment with this recovery from the panic of a VIX 60 down to a Lehman Brothers 30, and now breaking through 21, right now 18.37, is someone who writes a note here. She's not as distracted as she was 10 days ago. Virginie Maisonneuve with us right now, and of course with Allianz Global. And of course, Virginie, she says, let's get back to basics. But, Paul, she's been distracted. Let's look at Maisonneuve 2 weeks ago. Did you ever swim in the River Seine?
Never. And, I want to believe that the cleanup program has been good, but I'm not sure I would do it today either.
There we go. Virginie Maisonneuve on the Olympics. Virginie, just to waste 30 seconds here, what triumph for the French people and for Mr. Macron. Politically, how do you perceive this will follow through in Paris and across the French Republic?
Well, sports and politics are very different. And, I've just written a piece called Summer Storms and Political Winds. And I'm really, I think we should be aware that the next 6 months are going to be really driven by politics.
Right.
As you know, in France, we have something that's been postponed from during the Olympics, given the results of the last elections that we had. And I'm afraid that all the great news and the great spirits from the Olympics might be swept away when we go back to electing the next prime minister.
You say get back to basics. When you look at earnings, part of basics is you have to generate revenues. One of our themes this week is corporations perhaps are losing pricing power. Do you agree?
Yeah. Yeah, I agree. And I think what's really interesting is if you look at the Q1, Q2 numbers that we had some very strong numbers. If you look at expectations for Q3, data has been cut in all regions. So you are seeing a comeback. Part of it is, of course, the disinflationary trend that helped companies on the reverse, right? And when disinflation is kicking in, it has an impact. So I think we should expect that combined with a global slowdown. So if you look at construction globally, if you look at the price of rebar, if you look at different elements, of course, with the longer tightening of monetary policy, it would be normal to see that slowdown taking place between now and the end of the year.
So given that backdrop, Virginie, where do you see, I guess, relative value for equity investors globally these days? Where's the opportunity?
Well, so volatility definitely will offer opportunity. I still like tech. As we know, tech was overextended, particularly in the large cap stocks. But I think if you see some sharp comeback in some of the prices there, you should position for the long term. I think we are seeing, if you look at current positioning of investors, there's still a very large underweight in healthcare. And of course, in the US, this will have a political element to it, but also I would say global investors have been shy of exposure to consumer discretionary. So you can see a rebalancing there. I still like on the long-term industrials. And I'm very concerned about dirty energy, if you want to call it this way, because of the warm war that we have ahead of us and the need for renewable to continue to take market share.
So we're just kind of finishing up this earnings season, Virginie. We're getting some retailers this week, kind of finishing it up. What was your takeaway from this earnings cycle here? Definitely some concerns, it seems like, in terms of corporates, in terms of future consumer demand coming. How did you look at these earnings?
Yeah, the consumer is finding it difficult. And, it's a trend that you see mostly everywhere. Asia is a little bit different. But if you look at German consumer confidence, although Germany might be helped by higher wages, inflation for real wages in Germany will actually do better this year than in the past couple of years. But generally, consumers have been squeezed, despite employment levels that are quite strong, but mostly through the lag effect of inflation. So I think what we need to focus on is the job market, resilience of the job market. And of course, this is where we're at a crossroad in a way, right? Inflation versus job versus growth, and continue to really understand the purchasing power of consumers in different segments.
One final question, Virginie. Where do you sit on the cliche that I want to be long America and I want to be long large cap America?
Well, I like small cap, actually. I think so. For us, it's not so much per country than bottom-up stock opportunities, and we find them all over the world. I like small cap because on the small cap had been really held back by a lot of the fear on higher rates, and actually will be a very big beneficiary of lower rates. And we find those around the world. But I think, the U.S. continues to offer attractive opportunities, but the top-down overweight the U.S. is not the name of the game, in my view.
Virginie, thank you so much. Virginie Maisonneuve at Allianz. We're starting with this. I'm going to bust his chops, but the guy coming into the studio right now. Did you see the size of his entourage?
Oh, I know.
I mean, he's at Marriott Bonvoy, and he's got to get the entourage
guy
that does it well. Sit down, because we got this is a 1 hour conversation. Anthony Capuano joins us from Marriott. I've cut to the chase. Lisa, review with Mr. Capuano is probably not briefed on this. The Rihanna lingerie CEO is going to save who?
Victoria's Secret, because remember we had the Starbucks, that was all the news about the CEO, so now another CEO change.
CEO's important, I guess.
Yes.
Why is this? What is, and you did this, I mean, you had one of the toughest acts to follow. I'm going to get emotional here over the death of the CEO at Marriott. People talk, you did it. What does a CEO do that makes Starbucks or Victoria's Secret?
Well, I think they if they're doing their job effectively, they quickly and clearly articulate a strategy that the organization can wrap their head around. They give that organization the tools to execute against that strategy, and in some ways they get out of the way.
And then
let
you work
people do
70
their
hours
job.
a week, and what people don't realize is, Paul, I mean, Mr. Diamond's, his golf stream's a little nicer than mine, but you guys travel nonstop.
Well, certainly CEOs in general travel. We're in 141 countries, and so the highlight of my job is to get out and see those.
Okay, I got a bone to pick. I mean,
right.
you got, what are you making now? Where are your margins right now down the income statement?
At the property level?
At the Tony Capuano level, where are your margins are solid, right?
Very solid.
That's because you quote it in euros. At Rome at the St. Regis, sold out through most of October, you're popping $1,727.34 per night. How did that happen? Is there a hotel shortage?
I think across Southern European markets like Italy, Greece, Spain, there is an almost limitless appetite, particularly from high-end American tourists, to go to those destinations. And it's driving demand through the roof, and compression gives us pricing power.
What are you doing on the capital deployment side in terms of building, buying more properties? I know you're about to launch your 9,000th hotel.
Friday I'll be down in Longboat Key for the opening of the St. Regis Longboat Key, which will be our 9,000th
properties.
hotel.
I mean, so talk to us about growth. What do you tell the street for the next 2-3 years in terms of buying, building, acquiring, whatever?
Well, they're delighted to hear we're not buying.
Okay.
We have 9,000 hotels. We own 20. And I'd be happy to sell you any of those 20.
Okay.
So we want to be as close to a perfectly asset-light model as possible. Doesn't mean we don't use the balance sheet for growth, whether that's minority equity, mezzanine debt, credit guarantees, and the like. But what we said, we did an analyst day at the end of last year, and we said we expect net unit growth to be between 5.5% and 6%. In Q2, we delivered 6% growth. And obviously, that's on the biggest base of any player in the sector.
Why asset light? It sounds good to me as a potential shareholder because I think about it, I don't have to deploy a lot of capital in the ground and everything. What's the asset light model? And is that
really
different from
eliminates a lot of the volatility that you have as a big real estate owner.
Okay.
Right? Because a disproportionate share of our fees are off top line revenue. And so you don't have that volatility that a hotel REIT has, for instance.
You know, I've seen a lot of news just recently. It's the 1-year anniversary of the Maui Wildfire. God, I can't believe it's been a year. And that was obviously a huge impact on that part of the world. How did it impact you guys?
It was devastating. We lost 3 of our associates in the fires. A couple hundred of our associates lost their homes.
You've got properties there.
Yeah. We have a big footprint in West Maui. I was there about a month ago as part of the recognition of the 1-year anniversary. But they are coming back. We had the commander of the Army Corps of Engineers give us a tour of Lahaina. I think there were 1,140 some odd residential lots. 1,120 have been fully cleaned. There's a house under construction in Lahaina, which was a great symbol. The hotels are back and running. Occupancy's up to about 60%, but they need us to come visit.
Right.
Tell us about destination vacations. We're all commiserating here about, the fam and 3 kids going down to Disney World, not your remit. And it's just outrageously expensive. It's almost like we've priced the American middle class out of the vacation market that we all knew as kids. Where's that going to be in 5 years?
Well, it's a great question. It's part of the reason we've entered the mid-scale segment, which was a tier of our business we had not operated in previously, because there is that value-focused customer that says, it's not really in my budget to go to an upper upscale or a luxury hotel.
Yeah, New York Regency, the St. Regis under beautiful construction. I've been over there twice now. Your people are total class act, given the construction that you've got on the first floor. Paul, $1,375 a night just to get in. It's a little cubby hole in the 6th floor. What are you going to do in the middle level?
So we've launched a new transient mid-scale brand here in the U.S. We launched a extended stay mid-scale suite in the U.S. We acquired a company called City Express in Mexico, which operates squarely in the transient mid-scale. And we've launched a brand extension in Europe and Middle East called 4 Points Express. So we've got a variety of growth platforms that will allow us to really offer the sort of value accommodation.
How do you deliver margin there like you can easily do in the luxury area?
It's a very lean operating model. So you don't have bellman, you don't have doorman.
Right.
In some of those, you have no food and beverage offering. Clean, comfortable, efficient operation.
When are you going to start a share buyback program like Apple?
Well, I don't know that it'll be like Apple, but on our Q2 earnings call, we affirmed our guidance for full year that we'll return $4.3 billion to shareholders through dividends and buybacks.
What's the, just real quick, what's your perspective, the consumer? How's the consumer out there?
Yeah, it's interesting. It's really sort of bifurcated, I think. I think that at the lower end of the income brackets, that consumer's feeling a lot of stress.
Okay.
The confluence of interest rates and inflation, they're under a measure of duress, and you see it. In fact, if you look across our industry, the economy segment, where we don't play, was the one segment in the industry that had negative RevPAR in the quarter.
Anthony Capuano, thank you so much. He is at Marriott, their chief executive officer. Just a sterling job in driving the ship. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.